Ladies and gents, a very warm welcome to our channel Polo Vega. On today's video, we shall talk about advanced option trading strategies where we use an offset unit to remove/reduce the effect of undesirable characteristics that make it difficult to trade by taking a position solely on the anchor unit or the principal unit. But before we move on to our video, let's look at the disclaimer/disclosure clause. Disclaimer/disclosure clause. The contents of this presentation are for information purposes only. The material has been obtained or derived from sources believed to be accurate, but we do not guarantee its accuracy. The presentation is the 13th of a series of interactive videos aimed at educating our viewers about the advanced options trading strategies using various combinations of core and put options with other options or position on the underlying asset. Key option strategies for every investor. Options are one of the deadliest weapons in the world of trading and investment that one needs to handle very carefully with a repertoire of simple strategies that can help us enhance our returns, speculate on market movements, and hedge exposed positions. Some of them are as follows: covered calls, protective collars, married puts, bull call spreads, bear put spreads, long straddles, long strangles, long core butterfly spread, iron condor, iron butterfly. On this video we shall talk about the first 5 option strategies and the other 5 shall be discussed in our next video presentation. Covered call. The simplest strategy with calls is to buy naked call options if you expect the underlying to move up. However, there's a counter trend strategy or bearish strategy called a covered call or buy right, where you get long on the underlying and then sell or write a call on the underlying for a set price at which you wish to sell your shares. It's a trade-off where you can generate some income while holding the shares and reduce some risk while staying long on the underlying. However, if the call gets triggered and the underlying continues to move up, one has to be ready to sell the shares off at the strike price. Thus, one can limit the risk of selling a naked call by taking a long position on the underlying. Investors use this strategy when they take a short-term long position and are neutral about the market direction. The strategy adds an income to their existing position through the option premium earned from the sale and protects them against a potential decline in the value of the underlying. The adjacent chart shows us the profit and loss from a covered call. The negative P&L on the core right position is offset by the long position as the value of the underlying goes up. Since the seller receives an option premium while writing the option, the long position on the underlying gets sold at the strike price plus the premium received. The red and green line looks very similar to the dot plot of a short naked put. Married put. In a married put option strategy, an investor purchases the underlying first and then purchases the put option for an equivalent size of the underlying. An investor chooses to buy a put option against his long position on the underlying to protect himself from the downside risk. It's a bearish position that helps put a price floor for a long position in a bearish market. That's why it's sometimes called protective put. The strategy helps the investor with a long position on the underlying protect himself from downside risk, and at the same time he can participate in the upward movement of the underlying. However, if the market does not go down as anticipated by the put option buyer, he ends up losing the option premium paid by him to buy the put option. The adjacent chart shows us the profit and loss from a married put. The dotted line on the left shows us the P&L on the underlying with price movement to the right, and the one on the right shows us the P&L of the long put option. The solid line shows us the P&L from a combined long position on the underlying and the put. The solid line actually resembles a long core option position. Bull core spread. In a bull core spread strategy, the investor simultaneously buys core options at a specific strike price and sells an equivalent number of core options at a higher strike price. Both the positions are on the same underlying asset and have the same expiration date. This is done by an investor when he's bullish on the underlying but does not expect the price of the underlying to go too far. By selling the call option at a higher strike price, which could be at the money or 1/2 out of the money, he manages to reduce the option premium spent on the trade. The trade reduces the net option premium as compared to a long naked option trade, but also limits the profits from the trade if the market goes above the higher strike price at which the call option was sold. It's a bullish strategy as we expect the market to go up in order to make a profit from the trade. The adjacent chart shows us a profit or loss from bull spread using call options. The two dotted lines show the individual long and short call profit and loss curve, while the solid red line shows us the reduced loss and the reduced or limited profit from the combination of both positions with change in price of the underlying. When the option premiums are inflated, this strategy can be used to reduce the net option premium for taking a long position on the underlying. Bear put spread. Bear put spread is another vertical spread that an option trader uses to enter a market with bearish sentiment, or in other words, expects the value of the underlying to decline in the near or short term. While following this strategy, the investor simultaneously purchases put options at a specific strike price, then sells an equivalent number of put options at a lower strike price on the same underlying and with the same expiration date. Since the put option that he sells is at a lower strike price, is further away from the current price and hence has a lower option premium. The entry into the second trade reduces the net option premium for the bearish position taken by the investor. However, it also limits the profits from the trade if the current price falls below the lower strike price and the second trade gets exercised. This puts a limit on the profit made from the purchase trade at a higher strike price. The bear put trade is mostly taken by investors who are bearish on the underlying and expect its price to decline in near or short term. The adjacent chart shows us the profit/loss from bear spread using put options. The two dotted lines show the individual long and short put profit and loss curve, while the solid red line shows the reduced loss and the reduced or limited profit from the combination of both positions with change in price of the underlying. When the option premiums are inflated, this strategy can be used to reduce the net option premium for taking short positions on the underlying. Protective collar. A protective collar strategy involves the buying of an OTM out of the money put option and simultaneously writing or selling an OTM out of the money call option while already in possession of the underlying asset. This strategy is mostly used by investors holding long position on the underlying and having made some profits on the asset. They use long put to protect their downside by paying a small premium while the current market price stays above the strike price of the put option. By selling the call option, the investor tries to compensate for the option premium paid to buy the put option. Since the call option is also an OTM, the current market price is below the call strike price. The premium obtained by selling the option is quite low, but one can't rule out the possibility of getting assigned if the call option gets exercised with the current market price reaching the strike price or overshooting it. Therefore, the second position of writing an OTM call option puts a limit on the profit that could be obtained by selling the underlying at prices higher than the strike price of the call option. The adjacent chart shows us the profit and loss from a protective collar. The red line in the adjacent chart shows us the long position on the underlying asset, which goes up or down as the price moves up or down. The blue line shows us the long put position, which protects the investor from downside risk. The third position is represented by the green line, which is a short call position, which reduces the option premium, but one needs to be prepared to deliver the underlying at the strike price X2 if the current market price is equal to or higher than X2. The purple line shows us the effective profit and loss curve, which limits the losses as well as profits on the long position on the underlying asset. We hope that you enjoyed a short video presentation on advanced option trading strategies their risk versus reward profile, and the role that each of them play in limiting the risks as well as rewards by the addition of the offset unit, which is the additional position to the anchor unit. The offset unit tries to remove or reduce the undesirable characteristics brought in by taking a position on the anchor unit. In our next video, we shall touch upon the other 5 advanced option trading strategies which can reduce the risk from the positions on the option trades and improve the chances of profitability from the trades undertaken. If you liked our video, please give us a thumbs up and press the button underneath to subscribe to our channel Polo Vega and watch all our videos. You may also visit us at our website www.polovega.com or get in touch with us through our Twitter handle @PoloVega. We thank you for watching our video and look forward to see you on our next video with more on advanced option trading strategies.